Welcome to the BF Anderson Technical Report for April the 1st. This is Jesse Livermore. Interesting study. A book written about him called, well, it's actually a novel, but it refers to a young man, so we all know it's Livermore. Written by Edwin Lefebvre, called Reminiscences of a Stock Operator. Livermore in 1929 was worth $100 million, and in 1929 he was considered one of the wealthiest men in the world. Very successful. He started out as a young man in bucket shops. It's kind of like reminiscence of this Robin Hood thing. A bucket shop is where they dealt in derivatives. In other words, you never took ownership of anything. They would write the price. His job, he had a job working at a bucket shop where you would write the prices on the blackboard, and you would actually speculate on the prices, but you never took ownership of anything. It's kind of like the options market, but with the options market, you actually, can exercise the option and take ownership. But anyway, this quote is interesting. He says, "First, do not be invested in the market all the time." Boy, I completely agree with that. He said, "There are many times when I have gone completely in cash, especially when I am unsure of the direction of the market and waiting for a confirmation of the next move. Second, it is the change in the major trend that hurts most speculators." Now look, the word speculation kind of gets a bad rap. Speculation, the Latin word is speculare, which is the same word used for the word spectacle, which means to see. So when you're speculating, you're trying to see the future. You're trying to speculate on what is coming, what is the next big thing. So anyway, it's interesting that Livermore is saying this because I certainly agree with his strategy. Very successful investor. So let's get right into the charts. Here's the NASDAQ. You can see here that we've got the 10-day moving average kind of limping along here, actually kind of a little bit of a downtrend. However, today kind of popping out a little bit, a little encouraging. Still not seeing the volume that we need to see for a confirmation of any type of breakout. Now here's the S&P 400, which is the mid caps. Again, we're getting somewhat of a breakout on low volume. Here's the New York Composite, which is all the stocks on the New York Stock Exchange. Looking okay, 10-day moving average kind of down, a little bit sideways. We're not seeing an overwhelming attitude about buying here. We're not seeing the confirming volume that we need to see. Here's the small caps. The small caps kind of got hammered a little bit here, broke below that 50-day, stabilized. 10-day isn't a downtrend, a little bit of improvement here. So we're not screaming bulls right now, but we do see some improvement. Now here's the big improvement though, is the S&P 500. The S&P 500 has broken out to a new high above this base, but we're not seeing the confirming volume. So be a little suspicious of that move. Now, on a longer-term basis, this is a weekly graph where we've got the 35-week moving average. We're still in a bull market. We've been in somewhat of a correction here where we pulled back on a weekly basis. Continues to look good. Now, this is where things kind of get interesting. This is a ratio that we do called the aggression index. You can see it's been getting hammered here. It's been really, it's making lower high, lower high, lower low, lower high, lower low. So what's happening is that when you're a large institutional investor and you can't really go to cash, what you do instead is you start buying things like consumer staples and utility stocks. It's a defensive move. This is not a good sign. However, we are holding above that 40-week moving average on the actual indicator, but you can see here that on a weekly basis, this indicator has come down. Now, on interest rates, we're seeing 1.746 today. Rates are moving higher. Price of oil has softened up somewhat, still hanging around that $60 a barrel in West Texas. Financial stocks continue to be okay, but flattening out a little bit. New lows, we got a spike in new lows during this correction. Usually when you get these corrections, you'll get a spike in new lows. Now they seem to be somewhat stabilizing, but we are at 37 as of yesterday. Now, on the put-call ratio, we're seeing a little bit of improvement there. We're seeing a little bit of fear coming into this market, which is good. Greed got really out of hand here, but we've moved up a little bit here around a reading of about 0.50. Would be nice to get it back into just a normal zone. Volatility index continues to be fine, below 20. It's at 1914 right now. We would like to see it kind of stabilize back in this area. You can see here's the panic that came in during the coronavirus, and we've been basically improving ever since. Now, we had mentioned the aggression index. I wanted to also mention the consumer staples sector fund. You can see here it's been really moving sideways for an extended period of time, but we've gotten a breakout here, which is not really that good of a sign. We don't really want to see where institutional investors are running for the hills, and they're kind of running for the hills right now. So just to be aware of it. Now, also, I wanted to mention China for a minute. The Chinese stocks have really taken it on the chin. This has been one of the top Chinese stocks out there. This is called Baidu, which is the Google of China. You can see here really getting hammered, pushed all the way down to the 200-day moving average, kind of bouncing a little bit. But China's looking a little rough around the edges. Here's the Golden Dragon, which is all the Chinese stocks that trade here in the United States. You can see the same pattern, came down to the 200-day, bounced off a little bit. We'll just have to see on China, but I would avoid China right now. Now, I thought this was an interesting graph. What I've taken here is the 20-year Treasury bond, the TLT, which is a fund, compared to the S&P 500, which is stocks. So when the ratio goes down, it's simply saying that bonds are doing worse than stocks, and it continues to hit new lows. So as the bond funds continue to have poor performance, we think that what's going to happen is you're going to see a retail shift or just a general shift away from bonds, more to stocks, and you can certainly see what's happening and why that could happen and continue to happen. Now, this is an exchange-traded fund on the material stocks. You can see that the material stocks have really been in a very strong uptrend. Here is aluminum. I've got the Dow Jones U.S. Aluminum Index. You can see here aluminum broke out, consolidated, broke out again, consolidated, and is now breaking out again. The metal stocks are getting very strong here, which kind of whiffs of inflation, but we'll see. Now, this is the steel index. Same thing. You can see here consolidation, breakout, consolidation, breaking out, actually hitting a new high. We own some steel stocks. They're very strong. Here is home construction. You can see again a long period of consolidation and now breaking out. So the home construction industry continues to stay strong. Here are the top five. Now, the number one stock here is Williams-Sonoma, which we own. We own this stock. You can see here on this gap up on this heavy volume day of 6 million shares. Stock normally trades 1.5 million shares. Broke out on a gap up, broke out again, consolidating and trying to break out again here. Stock is very strong. Here's TripAdvisor. Again, this is some of the travel stocks that are starting to look interesting. You can see here it did break down below that 10-day moving average, has somewhat consolidated. I would wait on this one. Doesn't look that powerful. Spirit Aerosystems. This is an aerospace company having to do with the airlines. You can see here broke below that 10-day, got down to the 50-day, back in an uptrend. It looks okay. Alcoa Aluminum. We mentioned the aluminum prices earlier. You can see here Alcoa hit an all-time new high today. We've been seeing some pretty steady volume, above average volume. Stock continues to look positive. We do own Alcoa. Here is Alliance Data Systems, or ADS. New stock on the list. Very powerful uptrend, came down, consolidated a little bit, broke out again, and is holding in here well. I would continue to keep an eye on ADS. So that's it. If you have any questions, please give me a call. Thank you very much.